So if you have been in a business owner advisory conversation in the past 2 or 3 years, you've almost certainly heard about private credit. Advisors are talking about it. Financial media is covering it. Product manufacturers are packaging it for retail investors. And the returns being quoted 8, 9, sometimes 10% are genuinely eye-catching at a time when a lot of portfolios are searching for income. But before you allocate anything, it's important to understand what this asset class is, where it came from, and why it's grown so fast. Because the origin story has a lot to say about the risks in private credit. Hi, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth. We're an elite wealth management firm here in Texas. Private credit is at its most basic level a loan. A company needs financing and a bank will either not lend it to them or the terms are not attractive. And so a non-bank lender, may be a credit fund, an asset manager, or a business development company, steps in and makes the loan directly. Now, your typical borrower is a mid-market company, not a household name, not large enough to issue bonds in the public markets, but a real business with real revenue. And the lender, which could be the private credit fund, collects interest on the loan, while investors in that fund receive a share of that income. So that's the yield story you're hearing about. What's important to understand is these are not traded loans. They're illiquid, which means they're hard to get your cash out off schedule. The terms are negotiated privately. The pricing is set in the private markets. And the reporting is far less transparent than what you would see in a publicly traded bond. The modern private credit industry is, to a significant degree, a product of the 2008 financial crisis and the regulatory response that followed. After this crisis, policymakers introduced Dodd-Frank and a series of international capital standards known as Basel III. Now, they were put in place for good reason, but they raised capital requirements for banks and tightened the underwriting standards across the board. The practical effect has been that making smaller, riskier loans to mid-market companies is just not economically attractive for regulated banks. Community banks, who historically been the primary capital source for small business, pull back further, squeezed by compliance costs that hit smaller institutions disproportionately hard. They don't have the scale to divide that cost of compliance across numerous dollars. So this is why private credit funds have stepped into the vacuum. They're not subject to the same regulatory constraints. They can move faster, they can underwrite more flexibility, and accept risks that banks are no longer willing to carry. The result here has been dramatic growth. And therefore, an asset class that barely existed at scale before 2008, today manages approximately $2 trillion globally, a 10-fold increase in just 15 years. It's worth noting that this growth has had real economic benefits. According to a 2024 report commissioned by the American Investment Council, private credit supported approximately 1.6 million jobs in the economy and contributed about $224 billion to GDP. Now, for business owners in states like Texas, California, and Florida, private credit has been a meaningful source of growth capital in sectors ranging from manufacturing to technology. But this is not a story about a purely extractive industry. For a long time, private credit genuinely filled a need that the regulated financial system has left unmet. But understanding those benefits for the economy is not the same as endorsing the current retail product landscape. And that's where this conversation gets a lot more complicated, which is what we'll cover in the next video. So if you're a business owner or a high net worth investor who is being presented with private credit opportunities, the most important thing you can do before committing capital is understand the full picture, not just the attractive yield story. At Avion Wealth, we offer a complimentary second opinion review for investors evaluating alternative allocations. And if you'd like a structured conversation about whether private credit fits your broader wealth strategy, we would welcome that discussion.